Hi, Brian Evans here. Today's topic is called Step Up in Basis. Now, that's not a dance move. That is something that a lot of people have questions about. They don't quite understand the concept. I'm finding, in fact, even accountants don't know, or realtors or attorneys. So don't feel embarrassed if you don't know what that is. So I want to get into kind of the basics of the Step Up in Basis. So basically, let's say I'll do some easy examples here. The first example came from one of my chapters in one of my books, Prosperous Revelations. It's called Grandma, Please Don't Give Me Your House. So it's kind of a pithy little saying there, but it's true. If my grandma wanted to give me a house, and let's say she'd paid $100,000 for it way back when, and now it's worth $500,000. And I say, Grandma, you better give me the house now because we don't want to have to go through probate. And she said, yeah, that's what we need to do. So Grandma gives me the house, and I get what's called the cost basis. Her cost is $100,000. That's what she paid for it. That's my basis. Had she sold it and given me the cash, she would have sold it for $500,000 at a $100,000 cost basis to it, a $400,000 gain. She would pay tax on the $400,000. Well, she didn't want to do that, so she gave it to me, and then I sold it. Well, gift basis is what's transferred over in this case. So when she gave it to me, she also gave me her basis. So now my cost basis is $100,000. If I sell that property, I have a $400,000 gain I had to pay tax on. So either way, one of us is paying $400,000 if she gives us the house or if she sells the house. What if, however, she just kept the house and she's getting on in years and then she passed away? Well, on the date of her death, it no longer matters that she paid $100,000 for that house. Now her new cost basis has stepped up to its fair market value. Its fair market value is $500,000. I inherit that house. The house is worth $500,000. I sell it for $500,000. My cost basis is $500,000. I don't have any gain. So I pay no gains on it, not 400,000 in gains, no gains. So that's the basic of a step up in basis. Let's say, however, we have a husband and wife in the state of Washington, a community property state. There's 9 of them, and they have a rental house, and they paid 500,000 for it, and now it's worth $1 million. So you're thinking, well, you got a $500,000 gain if you sell it. No, they've taken depreciation deductions. They've depreciated it down to 100 grand because they've taken 400,000 of depreciation deductions over the year. Now they have a $900,000 gain. They sell it for $1 million. Their cost basis is 100,000. Well, in the state of Washington and the 8 other community property states, when either the husband or wife passes away, there's a full step up in basis. So the new cost basis is $1 million. So the surviving spouse could now sell it for $1 million and pay no income tax on the sale. This could apply to a stock, to any capital asset. Conversely, if you're in a common law state, one of the 41 common law states, you get a half step up in basis. So a little bit different rule applies, but you're probably getting the message here that if you have gains, capital gains in real estate or stocks or your business or whatever that long-term investment is, currently under the laws, those gains are eliminated at death or second death in a common law state to the people that inherit it. If they're given to those people, the taxes are going to go with it. If they're sold before you pass away, the taxes go with it. So in tax planning, we need to be cognizant. Do you have any highly appreciated capital gain assets in your portfolio if you're getting up there in years? And are there ways that we can take advantage of the step up in basis to leave more money for your heirs and charities and less for the tax authorities? So that's my talk about step up in basis.